Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
It's weekend time once again, and finally, at the end of the day, the weather actually got better after a month of completely depressing, cloudy and rainy type of environment. We finally have a little bit of sun back. So let's dive in and let's have a look at what happened this week. So welcome back for another weekly market recap. Now, the week, as you know, from a price action standpoint, I think it was a little bit dull. Not huge things did happen, but especially toward the end of the week, we got a lot of things which came out from economic data, from geopolitics, and, you know, not to mention the Supreme Court actually ruling at the end of the day. So, you know, for obvious reasons, the news, it's too fresh, and I don't have a lot on that. So not going to dig on what could this ruling actually means for, you know, the economy, the markets, and all the rest, but just a tiny little bit of a hint to it. And as for the rest, we are going to discuss what happened in the stock market. And again, back to this theme of sectors rotations, valuations, and all that nerdy stuff that you might like. Maybe not now, but, you know, in the future, you might think, if I only knew it back then, right? So let's just right into it with the economic calendar first, and then all the rest as for the usual schedule. Having a look at the economic calendar, the beginning of the week was pretty dull, and things started to warm up only on Wednesday with the FOMC minutes, which, you know, we're not going to go through. Just so you know, it was a bit more on the hawkish side than expected, but, you know, that's it, right? As for the rest, on Thursday, we started to have a look at the trade deficit, or the balance of trade, right, which widened, right? Now, again, it looks like it is getting back to the usual path, right, for this metric right here. And, you know, it was nice to see it shrinking, but, you know, when you check into the details and you see that a lot or a big contribution to that shrinking process was actually the exports of not monetary gold, you know what's going to happen. It's not like you can keep on exporting non-monetary gold forever unless you have other factors stepping in, sustaining the shrinking process. You know, at a point is going to fade, right? And if you look at the aggregates, yeah, sure, the deficit actually narrowed against the European Union or China, but at the same time it widened with Mexico, Vietnam, which, if you remember a little bit of the past, it could be seen as another way to say China, because China was moving inventories in Vietnam to circumvent the tariffs. And then from Vietnam, those inventories were actually sent into the United States. So, you know, you say Vietnam, is it kind of like the same of saying China? Maybe, maybe not, maybe to a lesser degree than what it was initially. But, you know, I still see it as a little bit of a shady area, so to speak. And that, of course, Taiwan, right? So we'll see how it goes. I think, you know, it is, or there are good reasons to try to shrink the deficit, but, you know, claiming to do one thing and actually having good reasons to do that is one thing. Actually succeeding at it and changing the structure of the global economy or international trade, it's a whole different thing. And even if you are successful at it, it's not something that you can do in like 9, 10, 11 months, right? So we'll see how it keeps on going. After that, we got the jobless claims, which again, at this point, I'm losing a little bit of interest in this metric. Sure, I mean, we keep on looking at it, but they came in at a relatively cool level, you know. It wasn't hot like a lot. And it's going down, right? After the peak in here in September, it's always going down. So there is nothing new into it, right? Let's have a look instead at PCE year over year. And now we are talking about the headline, not the core, just the headline PCE. It came in at 2.9, which to many people, it's, again, inflation scare and all the rest. I mean, really, to me, it's just at the same levels it was back in March 2024. It didn't really go anywhere. Now, you might say, if you want to sustain the bullish thesis for inflation, you might say that, inflation is normalizing at a level which is a little bit higher compared to what it was pre-pandemic. Sure, all right. I mean, it tends a bit more toward 3 rather than toward 2. But, if you zoom out, has it ever been right at 2? Well, for a brief period in 2018. But more often than not, when people wanted to see this metric around 2, it was below. And the Fed was actually scratching their head in order to come up with a solution to actually generate inflation and getting inflation back to target. Now, sure, the 2% target, it relates a bit more to CPI than PCE, but, it's still, you could use it as a reference point, so to speak. And you've seen that over the last 10 years, we gravitated around it more often than not, if you take out the pandemic shock, right? So I don't think that that's really a huge deal, right? But, sure, the usual inflation doomers will keep on come up with something like this to justify potential forecasts of inflation getting back to 5, 6, 7%. I don't see it for now, but, I've been wrong in the past, so who knows, right? After that, and look, this is why I don't necessarily see it, right? Because if you check personal income, which is not plummeting by any stretch of imagination, but if you check over the last 3 years, it's kind of, at the one of the lowest levels we have seen it over the last 3 years. So, I guess it's hard overall to generate a sustained inflation push if people are making less money, and therefore their purchasing power, their spending capabilities are going down rather than up. So there are many things to me that could invalidate the thesis for sustained and, coming back inflation in the near term, at the very least. Now, I'm not talking in 5 years or something like it, but, even in the next quarter, I don't see it. And just to be clear, whoever is trying to project things 1, 2, 3, 4 years into the future, more often than not, it's just because in my view, he's embracing a narrative. Because there is no way you can have the amount of data you would need, and you could actually discount all the potential things which could happen in the future in order to have an accurate prediction of what these macro data points will be 3, 4, 5 years out. All right. So, I think if you can get it for the next 3, 4, 5, 6 months at best, I think that's achievable. All the rest, going beyond that, I start to be a bit skeptical, right? I'm not saying it cannot be done. Sure, there must be some genius out there which actually could, but, I'm talking in general, all right? Now, after that, let's have a look at personal spending, which, again, particularly stable, which to me, it's, it's good and it's bad at the same time. It's good because somehow, even with all the gloom about the economy, the labor market, it looks like consumers are actually coming up with new ways to find out money to be spent, which is good, right? On the other hand, in order to have what people are calling a booming economy, yeah, I mean, if you are on the upper side of the K, right? you would like to see it going up, not being particularly stagnant at these levels, right? So, it's no bad, no good. It's just neutral for now. But again, just remember, in economic terms, and especially under our current system, when something is stalling, aka, it could be this metric right here, it could be GDP, it could be whatever. When something is not moving, it's not growing, it is contracting by definition. It is a debt-based system. So in order to, pay down the debt that you contracted ahead to generate this type of growth, you need to keep on growing even more, right? You need to go exponential. If you start to stall, then, the old debt catches up with you, and that's usually bad. But, that's more of a general topic, right? Ultimately, what we got was GDP, right? So GDP came in at 1.4. Now, the consensus was around 3, right? And the previous read was 4.4. So again, a lot of that has been due to what did I tell you, right? The shutdown, right? Everyone would point out to the shutdown saying, well, see that? This is because either the data came in badly or the market tanked or whatever. Okay, I mean, I'm not arguing against, if you shut down the government, a good chunk of the potential spending being actually executed, it might freeze for a little while, right? And remember, we got the longest shutdown in history, I think, the one ending in October, at the end of October. I think it was October the 20th. So, I'm not saying it didn't have an impact, but if you knew it, or, these analysts, these forecasters, they did know that we got the longest shutdown in history. So why then the consensus was around 3? I mean, could you have baked these into the cake and having a farther lower expectations, right? I don't know. I mean, it is just, and then you see, well, it was a huge miss. Well, maybe it was a huge miss because your expectations were a little bit badly calculated, so to speak. I don't know. All I'm saying is, look, no matter what, they're gonna keep this shutdown thing and run with that, in order, in my view, to mask an economy which, although it's still good, at the very end of the day, 1.4, it's not negative, it's not contracting yet, but it is still way below what you would see, again, in order to sustain this narrative that somehow the economy is booming, right? And look, if you start to look at 2025, now remember, we are going to have another, call it, it's not really a revision, but you get the gist of it. On March, in the middle of March, we're going to have new data for GDP in Q4, right? A new release for that. So it might be these 1.4 will be slightly different, right? But for now, if you average down the first, the second, the third, and the fourth quarter, now considering the totality of 2025, the US economy expanded at what? 2.2. And you remember when we were looking at all these GDP now projections and all the rest, what did I tell you back then? Look, 4.4. At a point, it was projecting 5, sure, on a quarterly basis. But I told you, look, it is very unlikely that we are going to have a situation where for the entirety of the year, this economy is going to grow at more than, 2.5%. It might get to 2, if you're lucky, 2.2, 2.3. Well, it looks like we are in line with those projections that, I did personally agree upon, right? We'll see in the middle of March what comes out, but I wouldn't be surprised to see it standing or staying around these levels right here, right? So in all of that, sure, the break-evens, they didn't move a lot. They were coming down. We were closing these divergence in. A little bit of a bounce, I guess, later in the week. I don't know if it was because of PCE or, another reason, but I I don't see them running away to the upside just yet. Well, I mean, it could happen in the future, but for now, don't see it. So Trueflation, a little bit of a bounce in PCE, 1.60 now, which again is still way below the official 2.9, right? As for CPI, below 1% by a smidgen right there, but still, I think the official headline CPI it's a what 2.7, so there is a huge gap, right? Fed Watch, I mean, I don't know what they're gonna do with that. I think what they are waiting for is to see what's gonna happen with the next CPI, because we are gonna get another CPI print before March the 18th, so the next Fed meeting. So I think, depending on how it comes in, these could change a little bit, but for now, not a lot. But again, remember, we are almost 1 month out, so there is a lot of time to either consolidate and crystallize these expectations or starting to change them. We'll see. As for the credit spreads, I mean, nothing really. So, there is not even a reason to check them out today. So let's just skip it. And with that, we can just transition into the next section. So we are now talking charts, and let's start out, as every single time, with the DXY, which again, didn't really go anywhere. I mean, it didn't go far enough, but sure, if you remember, these tiny little pause, this inability to keep on breaking down, yeah, we had another tiny bounce. Is it conclusive? I mean, not really. Didn't even close above the previous near-term high, so I wouldn't read a lot into it. Just the fact that, again, it was smelling a little bit like a trap in here, and it looks like it was some sort of a bear trap, right? So inability to keep on going down, struggling in maintaining the momentum. We got another thing coming, which again, it's not huge, at least for now, right? But we didn't keep pushing. So for now, I would say up until the point we are leaving below this high right in here, the best case scenario would be kind of developing a little bit of a range in here, right? If we can break above it, well, then, then it's game on to try and go targeting back into this cluster right here. There's a nice apex in here. Secondary apex could be kind of like, I would put it around here, to be fair, but it's not really cut and dry in my view. But if I had to pick toward the highs, but initially the level would be this one right here. Sure, that's predicated upon the fact that we can actually close above this near-term high. Otherwise, there is no trigger for that sort of a scenario. So, not a lot. And sure, now you got this low right in here, right, as your downside invalidation, aka if we drop, right, and if we break below this low, and then, maybe retesting it and being rejected once again, then that probably this whole segment of pricing here was just a pose, and eventually, slowly but surely, we will keep on falling down. But again, up until the point it doesn't happen, as I said, it was a phase, a stage in the market for me in the DXY where I was more keen on looking to what could have happened rather than taking not only a position, but even having a clear and very decisive opinion on that. It looks like, at the very least, it's one of those things where it can save you from, shorting the lows or longing the highs sometimes. So it's always good to have these sort of assessments when you look at the charts, right? Now, as for the other currencies, well, the euro kept on bleeding down, same as for the pound. Japanese yen, again, a little bit of a double top in here, if you want to call it that. It's not really, in my view, but, I guess there might be someone which is calling it a double top. Also because mainly because I do think double tops, they come, on top of a pump, while instead we are in a downtrend here. So, regardless of the definitions, we pumped, drew back in, bounced, bounce is faded, no continuation. So at the very least, you could expect a little bit of a ranging behavior in here, right? Up until the point you either take out the recent highs and you keep on going higher, right? Or, you take out these low and then you could target the lows below it, right? Kind of like the DXY. I mean, everything is kind of specular at this point. Canadian dollar, same. I mean, look at the charts. Like the British pound, the euro, Canadian dollar, the Swiss franc, they're all basically the same if you just check these last segment of price action. So if you can assess one, pretty much you got all the rest. With the due differences when it comes down to the fundamental side of things, right? So for instance, for me, the Swiss franc would deserve a little bit more of attention when it comes down to assessing the bullish side of things because of the safe haven type of trade. It has been seen for a long, long time as a safe place. So, before being particularly bearish on this one, I would need to be very, very bearish on all the rest, and particularly bullish on the DXY. So, there might be slight differences here and there, but if you just look at the price action, they're all the same currently. The other currencies, there's nothing new in the Chinese yuan, which again, it keeps on riding to the upside. The South African rand is still in this consolidation. The Russian ruble, again, we broke above of these daily range high, and we are consolidating above it, which, if you remember, last week was to be expected to some degree, right? Australian dollar, still among the majors, it confirms itself like one of the strongest, if not the strongest, right? The Brazilian real, good for now. Keep on going up. It's basically, I mean, if you look at that, it's kind of like the same pattern that the Russian ruble followed, but with much more strength, right? So, very similar all in all, but there is a little bit more of a strength into this one. The Indian rupee, it's just bleeding back into this huge gap, which, funnily enough, I didn't have the time. I actually forgot to check if that was due to news or a central bank intervention or whatever. I completely skipped it. Yeah. But again, regardless, you can't be bullish this one yet. I mean, there is no way I'm bullish this one. A chart like this, I can't be bullish. So that's it, regardless of whatever happened in here, right? Then let's have a look at oil, because oil had another good week. Again, nothing unexpected, because if you remember, we were in this range right in here, right? And the alert to kind of shift back to be a bit more bearish was to, breaking back below this current dealing range, right? Trying to bounce and being rejected, right? Which actually didn't happen. We tried to break below on, what was that? I think it was on Tuesday, right? Yeah, in here, as you can see, right? And immediately, we just shoot it back higher. And it looks like now, finally, we closed above this level, which was particularly sensitive in the past. Close above it, a retest back into it, and the daily candle actually closed above it. So, might be that this rally in oil has a bit more legs into it, which, look, it's fine, right? I mean, up until the point we were in this region, we were bearish, I was bearish, with the big caveat that, low, rejected it, no ability to keep on going. And then there was this key swing point we violated it, pulling back, and then up we go. So that's where you know something is changing, and you need to tame down your bearish expectations. And with the charts, a lot of things can actually shift. And when you start to factor in a lot of different stuff, even beyond the simple charts, you got your initial trigger, yeah, and then you look at what? Well, you look at the positioning, for instance. And if you check the option market, there are a lot of volumes getting in to buy calls. Now you might say, well, so what? Well, it's just an automatic dynamic and mechanic in markets. If you buy a call, right, someone else, the dealer, will have to hedge himself. How does he do it? Well, he needs to buy the underlying, right? So if there is a spree of calls being bought, that could actually move price by the simple fact the dealer will need to buy the underlying, generating what? Buying pressure. So, again, positioning might play a role, even in these short-term bounces and movements and whatever, right? Then you got what? The geopolitics, right? And you remember back in the days, I came up with that tiny little animation of the U.S. aircraft carrier, which was moving from the Pacific into Iran. And now, it looks like there is a huge armada in the sea right in front of Iran. And again, you don't move a lot of assets if you intend to do nothing. So I think the market, it's pricing in this escalation. And of course, given the fact we're talking Iran, we get back to the huge talks about the Strait of Hormuz might be closed in, and a conflict which could, bring in all the neighborhoods of Iran and the entire Middle East. So, the supply of oil could be constrained, right? Which is why I think the market is going up, among other things, right? So there is the chart, there is a fundamental set of things, there is a risk, which is geopolitics, there is the positioning, there is a sentiment, right? Myself included. I mean, when everyone was bearish in January, right? That's usually a good point for the market to put in a short-term low, right? And again, still same pattern, low, 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 an attempt to break below, rejected. Now, again, remember the DXY chart. We bounce, we try to keep on going lower, rejected. We break a very short-term structural high. And from that point on, that's where we said, look, at this point, something has changed, right? So I think there is the potential for oil to keep on pushing. Where to? Let's just try to draw a few levels. One would be this one. So 69 of all the numbers, right? But, realistically, 69, 70s if you want to pick the big figure. But again, I would think, as we've seen in the past, if we have an actual strike on Iran, this is the type of volatility that you should expect. Will it be long-lasting? I don't know. I mean, it depends. If it comes up to be some sort of a very quick and accurate strike, and that's it, maybe in the following days or weeks, the price of oil will get back to where it was before the strike. If the potential conflict, actually escalates, well, God forbid, you might see oil getting back into the 80s. So, I think there is a potential risk for an oil shock if things keep on going the way they're going right now. We'll see about that. I mean, up until the point it doesn't happen, of course, it's difficult to predict, right? But the risk, it's most likely there. Also, I mean, if you think about, I don't have a chart of that right here, right now, but think about the strategic petroleum reserves, which were depleted under the Biden administration in order to try to tame down inflation. You flood the market with more supply, and therefore you try to stabilize or bring down prices to to fight inflation, which was a problem, right? Throughout those months. But now, I mean, you have to refill them at a point, right? So you could make an argument that a lot of the bid which has been present in the markets was the government as well. I don't know how much I would believe that, but nonetheless, I mean, you would have to refill them at a point. If they are strategic, you know, it's not like you can have them depleted or empty for, I don't know, months or years. Otherwise, they stop being strategic. And again, strategic is a term which is referred to the economic side of things. I hear a lot of people saying, well, I mean, what if they ran out of oil? Sure, but look, the military has its own reserves, right? If you check and if you look to the point where the strategic petroleum reserves were established, they were established for economic reasons, right? And presidents on the left and on the right, they've always used them for economic reasons alone. It's nothing to do with survivorship of the country or, you know, emergency stockpile to fuel the, you know, defensive machine. No. Those aspects are already covered, right? So, you know, again, as you can see, there are a few points which could lead to higher oil prices right here, right now, with a big catalyst on top of them. So be sharp. There are opportunities in oil, absolutely, because, I mean, at the end of the day, it's coming up very orderly for now. So you see, breaks a high, consolidates, it breaks the high again, it consolidates, and then, you know, tries to break the next. So, you know, very simply, wait for the break, give it a little bit of time, try to buy in the low side of the range once it is established, and then, you know, try to ride it up until the next high is taken. Easier said than done, of course, because look how many times it came back down. 1, 2, 3, 4. So either you play it as a position trader, you get in and you stay in up until the point you are either stopped out, or again, you have a daily bar closing back below this dealing range, breaking it to the downside, and you just play the game of patience, right? Or, I mean, if you want to try to time these, it gets a bit more complicated. But, I mean, I'm not saying it cannot be done. Everything can be done if you have the right tools and the right skills, but I'm just saying one thing, it's easier than the other. But, you know, again, just play the trend up until you have the trend. And the trend right now is to the upside. So, at the very least, don't try to short right at that point when it looks like the market is weak, because it showed you many, many times that those points where it looks particularly weak, it's where you have your usual bounces. So just pay attention to that, right? Let's have a look at Bitcoin instead, which, I mean, it's kind of the theme of the week. Not a lot happened price action wise, and even Bitcoin stayed relatively flat. I mean, sure, maybe not for the week. Actually, for the week, I think it's down. Yeah, slightly down, yeah. But, you know, overall, from the beginning of February, basically since when we got these recent lows, it's been particularly stable in this range. It looks a bit weaker compared to, you know, other risk-on assets that held up, you know, decisively better than this one, right? But nonetheless, at least we stopped, keep on dropping. I don't really know what to make of this chart. Again, for now, I think we might even test back toward the lows, some sort of a final push, which usually would lead into potential outcomes. Either we keep on pushing hard and we break the lows, or we try to push hard and we have some sort of an absorption candle. It could be your, you know, if you like candlesticks, it could be a hammer to the upside, so a bullish hammer or something like it. And then you see the market taking out, like oil did, the most recent high, and therefore triggering a trend which now is shifting. But we got nothing of that right now. If anything, I was checking the ETF's flows, and it looks like outflows are still there. So people are still getting out of Bitcoin ETFs for now. Again, it might be, as is often the case, that the majority of people actually get shaken out at the ultimate lows. Sure, but I don't try to pick tops and bottoms. I just try to look at what the market is doing. And my main point of interest, again, it's trying to identify when something is changing, right? So we got this near-term high, right? And we have this low right in here. And at this point, you could almost say we got this tiny little low right here, which is just the low boundary of this dealing range. So a bullish case scenario for me, right, would be trying to deviate below this range low, right? Not taking out the lows, getting back in it, and then targeting the high side of the range. So usual stuff. And by doing that, taking out an intermediate high and potentially triggering a trend reversal, right? I mean, it's just an idea. I don't know if it's going to happen, or it's just an hypothesis. I'm not calling it, but that would be a nice way to do it. The other way would be just being fucking boring for maybe another month up until the end of March, so to speak. Keep on going sideways, just like that, right? And then at that point, trying to slowly but surely making high highs, high lows, and actually going up. So, I think there is a lot to be done here on the side of the bulls in order to convince me that this thing is not completely fucked. Which again, it's just a figure of speech. I don't think it's going to go to zero. I'm not Peter Schiff, right? So I think it's here to stay. The point is it going to stay? Yeah. At what prices? To be determined, right? But for now, doesn't look like the picture of a health and fitness, right? Let's have a look at something which is starting to look a bit better, which is gold. Again, it was a major scare, but look, at the very end of the day, you remember the warning that I gave out a few weeks back. It wasn't for a trend reversal. It was for, probably it's going to keep on going higher. Fundamentally, the reasons for it to keep on pushing higher, they didn't vanish, right? Just be aware that we might have increased volatility. So, the highs were at what? 5,600, more or less. We are at what? 5,100. A little bit more than that, but, still. So after the huge liquidation, what you got is high highs, high lows. So again, I think it's early to call the top on gold, in my view. And, I would prefer even a bit more of this choppy action if I wanted to be bullish. So the slow grind to the upside, quite honestly, rather than, again, as I said in the past, another moonshot straight to 6,000, right? And I think I'm gonna start to become a bear on gold. Actually, it's pretty easy, right? I mean, you got these lows right here, right? So what you need to see is, let's take this high, for instance, right here. Which would be in here. So let's say, simple example. We try to break this high, right? We fail. It could be a look above and fail. It could be a swing failure, whatever you. Then we come back down and we just break these lows, right? Okay. And maybe we bounce or we stall a little bit, whatever. And then we break these lows, right? So at that point, probably not so cool. So preliminary warning, inability to break a high. Like it was, look, it was basically the same in here, right? Look at this high. Look how many times we tried to break it. and we didn't. And what do we do next? Sure, we come back down. Down to where? Here, basically. So did we take out these low? No. And therefore, reaccumulation, and up we go again. So play the same type of pattern. Do we see another type of rejection? It could be, again, a swing failure, right, like it was in here. It could be, 1, 2 candle above it and then immediately rejected. So look above and fail. And then, check what happens when price tries to reapproach these lows. If they are defended, there are good chances that we are going to keep on pushing higher, right? So, pretty simple stuff at the end of the day. It doesn't have to be complicated, right? As for the other metals, they responded well enough this week. Not as good as gold, but for me, that was a given, right? I've always said, if I had to put a bet, I would keep on betting on gold. Maybe the percentage returns will be lower than what could be in platinum or in silver or whatever, but I do like the structure better, and I do like overall the commodity better compared to the rest, right? But nonetheless, the other precious metals, they did good, or you can't say they did badly. Let's have a look at silver, for instance. Opened the week in here, and it closed the week higher. And it's trying to target these highs, these intermediate highs right in here. So, huge liquidations, but metals are not completely defeated yet. Now, sure, you want to tell me, well, going from 120 back down to 65, it's almost a 50% pullback. Yeah, sure. But this is the type of volatility that you need to be able and ready to stomach if you want to stay in metals, right? Which is why it's always important to rebalance the positions as price goes up so that you bank the profits in. Psychologically, you feel better when something like this actually comes. And guess what? You have actual money to deploy back in after the storm has passed and you see signs that the market might keep on trying to go higher. Will it eventually? We don't know, but at least you got the money to try and play the opportunity. Then, again, just because it is an opportunity, it doesn't mathematically means that it's going to pay out, but at least, you have a process, right? So that would be it for metals. Let's have a look at yields instead, which a little bit of a bifurcation in here. Medium and long end, they are still a bit weaker compared to the short end. So we are seeing what? A flattener, essentially. And they bounced a little bit on the news. I think Friday was particular. Like, what I mean is, look, PCE came in a bit higher than expected. Then you got tariffs, which were declared not legit. So the market went up a little bit, even risk on assets, and therefore yields went up because PCE was higher. So, inflation, and then no more tariffs. At least that was the initial assumption. So, well, I mean, if tariffs were bearish when they were introduced, now if they are lifted or struck down, that should be bullish. So more inflation and more growth, aka yields tried to bounce, especially at the short end of the curve. Well, look, I don't really know if that's anything more than just a knee-jerk reaction and a spike in volatility, given the huge chunk of news, very impactful actually, especially they could be impactful in the mid to long term, that we had on a Friday. But at the very end of the day, I think this week, nothing really changed, right? This stuff takes time to actually manifest some intention or evidence of a scenario which is changing. So don't take any single intraday or intra-week move that you see in yields as the Bible, right? Because most likely it's not, all right? And at the end of the day, if you check the futures, look at where the 2 years yield. The 2 years is 104, more or less, which is basically the middle of this consolidation that is going ahead from where? Beginning of September. So, did it change something? Well, no. And still, if you zoom out on a weekly, let's say, it keeps on being the most bullish chart among these three. So really nothing really changed this week because we got that news or these news, right? So that's where I would leave it before getting into the equity market. As usual, a little bit of a pause, and then we're going to get back to it and wrap up the video. Talking about the stock market, as for the general price action, if you look at the hourly time frame, so going from Monday back to the weekly close, as you can see, we are trying, after this huge drop, we are trying to put together something which could resemble a short-term bottom. But, again, remember, an hourly chart, so, it doesn't tell you a lot about the next month, right? But it was a very nice behavior nonetheless. Look, and it's kind of always the same, which is why I say, more often than not, you don't need to overcomplicate things, right? But look, Monday start out, basically it's the same across the board. If not, well, the Dow is a little bit different, but just look at the two majors. So ES and NQ futures, Monday starts out and we immediately drop, right? Then we keep on dropping on Tuesday. We try to break these lows, previous Friday's lows, and we are what? Rejected, back up, right? And then look at the patterns, right? Massive low being put in, then we take out these high. I'm trying to zoom in a little bit, right? These high right in here, which was what? Which was the high in control of these down leg, which failed to take out the lows and having immediate continuation. All right, we take that out, pull back, and we keep on pushing higher. And we take out these other high. We keep on pushing, and again, every single time we take out another high. Now, sure, the market was particularly choppy, all things considered. There weren't a lot of, very huge, clean, and defined trends intra-week. But, this is also why when you see a market which goes like this, right? You remember all the charts that we were looking at before. Think about, oil, or think about, to some degree, the DXY. But, more often than not, as I said on oil, when it gets back to the previous lows of the dealing range, which was newly established, which would be kind of like this one, right? You see these area right here, right? We break out of these highs right in here after failing in breaking this low and maintaining below it in here, right? So what happens every time you get back to these highs, to these lows in this new dealing range, which actually applies to the highs as well? Well, we had, I think my screen just glitched a little bit. Hopefully it didn't ruin the recording. It looks like it didn't. So let's keep moving. I was saying, yeah, it applies to the lows and the highs. Every time we get back there to the upside and the downside, what do we got? Immediate mean reversion, which is also why I was saying throughout the week, I think it was maybe Thursday, Wednesday, don't really remember. But, for you, Wally, if you're listening, the reason I was telling you, wait for the market, I think it was in here. Yeah, it was Wednesday. Wait for the market to take out the previous day high or the previous day lows, right? And then trade in the direction which is unfolding from there. Because, again, it was Wednesday, it was in here. And you could have already seen this pattern developing itself. If you want to get into very nice moves intraday, intra-week. We did it in here, right? Pull back. And again, we kept on doing it. Like, this one right here was taken out and then up we went. And, I'm taking NQ as a reference, but we took out the previous daily highs and then look at the retracement. You can't really appreciate that because this is an hourly time frame, but those are 250 points of a pullback there. So, the market might be choppy, but it's going to present you with opportunities that could be very playable and very good and profitable if you have the patience to weigh them out, right? All in all, if you zoom out, what do we have? It's the market again. If you look at the S&P, nothing changed. We are still in the middle of this consolidation right here, right? Just stuck in the middle, right? Same for the Dow, which again tried to break above it and it fell back in it. So nothing changed. The Russell, as you can see, it's not going anywhere. Move to the upside, move to the downside, and we are still in here, right? And the Nasdaq, it's still a little bit on the weaker side compared to all the rest, which is why I think, we are looking at a market which is particularly stagnant. If you look at the sector rotations and all the rest, we have seen a lot of money coming out of communication, technology, software, and they went where? In energy, real estate, staples, utilities, the same things we were looking at last week. Now, as for the ETFs, again, the moving averages are a little bit misleading again in this segment. Sure, I mean, if you really want to read something in it, what I would read is that SPY is a bit stronger than the Qs, just by the simple fact that the Qs are below the 100-day moving average, daily 21 exponential, while instead SPY is above the 200 days moving average. And, it closed on a Friday, it closed above all the rest. So, a little bit of a relative strength into SPY overall compared to the Qs. As for the sectors, let's have a look at the chart of the different sectors. So this is XLK, technology, which it's basically reflecting the Nasdaq at the end of the day, as it should be, right? Then we got what? Look, energy, right? You remember we were talking last week about this huge divergence in between the price of the energy stocks and the underlying commodities, which would be oil. Again, at a point, one of the two would have had to give. So either we would have seen oil going up or XLE, aka energy stock, coming back down to reflect the price of the underlying commodities they actually do business with. It looks like for now, if you remember, it looks like oil is set to catch up. Now, how much will it catch up? I don't know. It could also be that they might meet halfway in the sense that we got XLE kind of pulling back a little bit while the price of oil comes back up. So they kind of converge to each other by, again, one going up, the other pulling back down, which, at the end of the day, it would close in the divergence anyway. So that would be the market getting back into balance somehow. And what we got is materials, which again had a decent, good run. So potentially, I guess at a point, which is it's not now, of course, I don't see it yet, but materials, to some degree, utilities, maybe a little bit of a lesser degree, but staples, boy oh boy. I mean, all these energy, materials, utilities, they could all be prone to a pullback or to a short, it could be a short-term top to be put in. Because again, we have looked at the fundamentals last week, and these things are trading like growth, while instead they should be value, right? So, I mean, there is something which is off there. And I think, I don't know how much the market overall can keep up with that, okay? So let's move on. This is consumer discretionary, which again, it's another one of those which could actually see a positive impact from the upcoming rotation. Now, the problem with that, as I stated over the last 2-3 weeks, is that the timing is always particularly difficult. But nonetheless, the opportunity might present itself, I think. When you might say, again, it's hard to put a timeline on it. I would rather, rely on the technicals and just looking at the charts in order to determine if something actually started as, a short-term top in those overbought sectors or a bottom in the undervalued sectors, and see if a rotation is actually starting. But, if you want to be, how could I say it? Proactive, you could start, for instance, trimming your profits in this one after this very good run, and putting a little bit of them back into this one, right? Will it play out? Will it not? Who knows? But at a point, mean reversion again, it's a very powerful force, right? Now, at this point, let's have a look at all of them. So communication services, they're here for now. So not a lot. Financials, they took a bit, as you can see. And this is another sector where I think, there is a little bit of a mispricing at the current moment in time. I don't think this is really a reflection of what is going on fundamentally for a lot of these stocks. Like, at the end of the day, they are making money, right? So the fundamentals are good. Sure, to some degree better than other sectors, which for some reason or another, I think mostly it's narrative, but they're running like crazy, while instead this one has been left out in the dust. There is one caveat though. We hinted at that, so let's have a look at the others and then we'll get back to it. Healthcare is another one where, I actually do think healthcare, it's not bad because it didn't run having that sort of a moonshot, but every time, goes up, consolidates the profits, it builds up the volumes, and then it keeps on going. It, sharp pullback, it keeps on doing the same. It builds up volume at higher levels. So maybe healthcare is actually a little bit of an outlier in the sense that it could keep on performing well. Also because, demographic would play a role. And even if you remember, every time we have a look at the labor market data, where is the majority of the new jobs actually created? Healthcare. So, there could be a good tailwind for this one going forward. And industrial, again, this is basically just a reflection of the Dow. And I think, for now, I don't see any immediate risk in this one. We'll see what's going to happen with these tariffs. Huge conversation there. But, it would take a lot to dig into it. And, after what happened on a Friday, I think that there is a lot to be unfolded yet. But, just for the sake of it, right? Everyone is saying that, tariffs were bad, so that now tariffs are gone. The market should be better. Yeah, sure, but tariffs were actually good for, in order, at least those were the intentions, to defend the American industrial sector. So now if you remove the tariffs, you actually remove a protection toward that specific sector. But again, we don't know how it's going to end up because, after the Supreme Court actually ruled them out as illegit, the president, of course, came up with these. So, it might be like tariffs are banned and then 3 days later, tariffs are back on. Because, and again, I don't know the laws in the US so deeply. But, they are making a reference to all these different acts of the past, which would allow the president to actually, impose new tariffs or substitute the ones which were struck down by this recent Supreme Court decision. I mean, to some degree, whether I do like Trump or not, whether you do like Trump or not, I think you can't deny the logic that it's a little bit ridiculous that you can basically cut off any other trading partner from doing business with the US, but at the same time, you cannot impose tariffs on those businesses. And I think if you scroll down, there should be a section where he says, so the president is allowed to give license, right? But he is not allowed to impose a license fee. And how many people are allowing a license without a fee? So, I mean, look, if you put yourself in the shoes of a businessman, someone which knows how companies and businesses actually work, it makes sense. The problem is that then it gets political and you never know what type of a rabbit hole you would have to dig in. But for me, the point would be that a lot of what you may hear, especially throughout the weekend, like, oh, yeah, the president is being defeated. We knew that these tariffs were bullshit, and now they are finally have been put to rest in peace forever. Well, I mean, don't be so sure, right? Don't be so sure. Also because, look, I mean, you can hate the man as long as you want, but would you think when he imposed the tariffs by executive order that he didn't know back then, and potentially those decisions and the way they were implemented could have been, appealed to or seen a legal opposition, and he didn't have a backup plan? I mean, you can say whatever you want, but I don't think he's a stupid man. So, case in point, a few hours after the Supreme Court struck down the tariffs, he is already talking about new tariffs. And actually, I think he just imposed a new, all across the board, 10% tariffs for some sort of an emergency, and it can stay on for 5 months. So, don't believe the headline and wait for the dust to settle a little bit. Which brings me back to this one. Tariffs were bad, yeah, for the rest of the economy, but for the industrial sector, well, they were good. So people might say, well, now tariffs are gone, so I would expect this one to roll over and die. Maybe, but we've just seen that tariffs can actually stay on using other legal basis. So maybe this is not going to roll back. So again, just give it a little bit of a minute, see how the market reacts on a Monday, and then we will talk, right? Real estate is the last one. So, a decent run. I think it was caught up in the rotation mania. But getting back, I think that there is a point I left out, and I intended to get back to it later on, which was about what? I actually forgot. I don't know if you... yeah, it was about financials. So maybe a little bit of this weakness we are looking at. It is also because what's going on with Blue Owl, right? We've been talking about Blue Owl 2-3 weeks ago. So private credit market. Now, if you followed what they did this week, they halted the withdrawals. So no more redemption. They just freeze the assets and the investors' money. Usually that's not a good sign, right? Because... it's not a good sign for Blue Owl itself. And I know they are trying to spin it as, well, we are all good. Yeah, sure, we liquidated a little bit of this and that, but if you check, we were able to liquidate those assets at what? 98.8 cents on the dollar. Yeah, I mean, maybe it's good, maybe it's not. To me, it looks like you needed to liquidate something. And then what do you liquidate in order to not generate even more panic? Well, you liquidate the things that you know you can liquidate at a good price. Sure, you're not going to liquidate something that you know you are down money on, because at that point you would actually realize a loss, right? Plus, I think it's not bad when you see these things happening because, people see a chunk of investors being stuck and trapped in these blue owl thingy right here. And maybe they are in something similar, which is not blue owl itself. And just for the sake of it, they might think, look, I don't know what's going on with blue owl. I don't like the fact that they can lock my money in, regardless of my willingness to lock them in. I'm in something which is very similar. It does the same thing as blue owl actually does. So you know what? Just for the sake of it, I'm going to put my money back and see how these things go, right? Because I don't want to be in the next blue owl and being trapped with my money in something, and I don't know when they will release my funds and all the rest. So I think the problem with that is, what did blue owl do in a nutshell? Because remember, all these things, all this money which are trapped in, those are consumers, retail investors' money. These are not institutionals, right? The point is that they want it, and that was something, again, it was claimed even at an institutional level in a few branches of the government. There is so much opportunity in the private credit market. We should be democratizing this market and allowing the mom and pop consumers to get access to it. The thing is that when you go to a bank, they go off risk assessment and risk reward type of metrics. So if I show up to a bank and I have a shitty credit score and I ask them the money, to borrow the money to participate in this huge opportunity in the credit markets, what do you think is going to happen? They're going to deny me because, well, you are not a good bet for us. You're not safe enough for us. So what things like Blue Owl actually may do would be, look, I have a very good credit spread. I'm a respectable company. I'm asking you money, right? And, they might get the loan. Sure. Then what will they do is to basically finance whatever type of new startup they want. And at that point, they're going to sell the new generated asset or the new loan to who? To the consumers. We didn't have access to that same opportunity initially because the bank wouldn't like to be exposed to them. But if Blue Owl shows up, well, I mean, yeah, sure, we are going to extend the loan out to Blue Owl. It is respectable. It's an institution. It's a company which has a good track record. Yeah, but then Blue Owl basically transferred that risk onto the consumers. So if Blue Owl actually goes down, those banks which actually lent money to Blue Owl, they are in trouble now. So this is why I think you might see a little bit of stress even in the financial sector, right? Because you never know what type of contagion risk you have. Now, again, I don't want to be the harbinger of doom and gloom. I think for now, as I stated 2 weeks ago, this seems to be contained. And I know those are the most dangerous words in the history of finance, right? But it looks to be a small niche of the credit market, right? And, the credit spreads overall, they're still relatively, flat. So I wouldn't run for the hill. I'm just saying that there is a huge risk of something blowing up in here. And, don't take my word for it. Do you remember what happened to Tricolor? And then UBS, which had to liquidate 2 funds. So, I think private credit actually ran too far. And a lot of risk has been taken. And now I think we are at that point where we start to find out who is swimming naked, right, so to speak. So just a little bit of an update to Blue Owl and how it could be related to the overall financial sector in the stock market and all the rest, right? That was kind of an off topic because, at the very end of the day, the market didn't really move a lot this week. So what are you going to do, right? Ending up the thing about potentially, market being particularly stagnant and potential rotations getting back in. Last week, we checked the difference in between the P ratio and the forward P ratio and the PEG ratio and all the rest. So, to expand a little bit on that, and if you remember back then, we were looking at things like this, like, we were looking at the PEG, and we were looking at stuff like CRM now or Adobe, which, by these metrics, they look particularly enticing to be a buy. The problem is that if you look at those sectors now, those stocks now, because of the narrative, because of the AI scare, they are not holding up particularly well. I mean, this is CRM, this is Adobe, right? And this is Now, which should be ServiceNow. Yeah. So I'm not saying these are things that you should buy, at least if you are a TA guy. For now, there is no reason. Sure, I mean, you could say this one right here, for instance, we tapped into a good pocket of liquidity in here, but realistically, I think it's still like for buying a falling knife. Adobe looks even worse, but my point is not about formulating or coming up with a setup and telling you that you should buy these software as a service stocks. I'm just saying that I think at a point, and it could be next week, it could be next quarter, I don't know. I'm just saying, look at these charts and look if we try to put together a bottom, because I think there could be an opportunity in stuff like this. Not only because of what we were checking last week, but, if you want it, put it black and white, look at that. Now, beside, the strength and the actual particular good aspects of these companies, but just look at the numbers. I mean, I'm not going to read it all, but, you see that one particular stock among these few in these sectors, which is beaten up right now, they do trade at forward P ratio, which, compared to the rest are not so exaggerated. And if you check the PEGs, right, the PEG ratios, all things considered, they are particularly close to 1. A few of them below 1, which is good, as we analyzed last week. But now, then look at the earnings per share, right? Earnings per share expected growth, 13, 9, 21, 11, right? And the operating margin, 22, 9, 15, 37. Just by comparison, Walmart trades at a 39 forward PE. The PEG is 3.20 almost. The earning per share growth is expected to be at 12%, and the operating margin is at 4%. So, again, when you need to assess value versus growth, or think there will be a story to be told about the specific sector in here in the coming future. Again, could be 2 weeks, could be 2-3 months. I don't know. I'm just saying, keep an eye out for them, because you might have an opportunity coming your way in the future, right? Which, again, look at the charts. It's not now, but, it could be at a point throughout 2026. So stay sharp. And after that, I think there is really nothing more I want to discuss. That was the week. So I'm going to wish you a good rest of your weekend and a good start of next week. Be mindful, be sharp, and as usual, be nice and be cool. Needs out.
Mm-hmm. 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 Come on. Mm-hmm. Mm-hmm.